Revelations from my man cave. My name's Jeff Banks and I'm from Property Portfolio Solutions. In fact, I'm the co-founder with all the tax experience, over 40 years of experience in the taxation of property, rental and property investment transactions. Now, when it comes to taxation, I like to think of a little acronym, LEI, that are really important when it comes to how we deal with taxation. The L obviously stands for lodge. We have to lodge a tax return. If we're an individual doing our own tax return, I have to lodge by the 31st of October, and that's not that far away. If I'm using an accountant, that can be for extended up to the 15th of May next year. Now, why would we do that? We might do that because we may have realised a capital gain and we've got a bill to pay. But if I'm expecting a refund, I'm wondering why all our returns aren't already lodged. Interesting question. Now, E. E is a really important one. It stands for evidence. That's all our receipts. That's all our, whoops, it has an E on the end of it too. That's all our bank statements. That's our statements from our property managers to be able to take the information and prove to the tax department whenever there's an audit situation that we have been able to ensure that we have claimed what we are entitled to. Now, there are traps. Obviously, the first one is interest. If I am on an interest-only loan with my bank, certainly I can claim the repayments as a deduction against my rent. But if I'm paying principal and interest, or I'm using a line of credit, or I'm using something that is not just simply interest only, then I have to make the calculation as to what is deductible. Now, with a principal interest only loan that is specifically for your investment property, most banks will give you the number at the end of the year to say this is the amount of interest we have charged you, and some banks will even put the bank charges on there for you as well. So it's easy to transpose that number from that statement to your tax return. When it comes then to, say, your depreciation claim, hopefully you've acquired your quantity surveyor's report that will detail each year the amount of claim that you are allowed to do. Now, you're going to be careful there in that most quantity surveyor reports will be in two sections. One will be the diminishing value method, the other will be the straight line method. The trap for young players here is mixing them up. If you decide to use one method, you have to stick with that method as you're going along. The third trap when it comes to evidence is repairs. Repairs are an interesting calculation. It's grey when you're looking at something that's only just been purchased. Did you purchase it with a reduced price? Then you've improved it up to a price where you're getting the rental return you've had, or have you simply had an oh my God, the chips moment where something has been destroyed and you had to replace it? Clearly, the oh my God, the chips moment is a repair, and subject to whatever insurance claim you might have been able to achieve from that, that will give you what your tax deduction will be, and that will be a claim against the rent. Whereas if I bought an older property and then done it up to a point where it's going to rent for a bit more, perhaps that's an improvement and should be subject to depreciation. Ask your accountant, have a talk to him. Remain. The second one here is, or the third one then, is intention. And this one gets a lot of people. And they may not think it at the time because their intention changes. I've had clients who will buy a property and then sell it because the market moves. Have we simply realised an asset, or have we been in the business of buying and selling properties? Now, that's an interesting concept, but we need to be careful of our intention. Are we going to be an investor collecting rent and heading off into the sunset with our rents? That could very well be. But all three of these are really important when it comes to tax. We need to lodge, we need to have the appropriate evidence, and we need to make sure that these two agree with this one. Now, when it comes to tax, anybody who's doing anything other than an ordinary salary and wage return, I suspect, should be using an accountant. Now, there are good ones and there are other ones. We won't be disparaging. But you think about, there's an old joke that I hear from time to time that explains fully why you should use an accountant. There's a guy who's the manager of a block of units. and all the toilets in the units are blocked up. He rings the local plumber, and the local plumber says it's a $500 call-out fee. Now, it's the weekend, I'm doing other things, it's a $500 call-out fee. The manager of the unit says, oh, that's exorbitant, too high, I'm not going to pay that. No worries, hangs up. The next day, the toilets are even worse. He rings up the same plumber. The plumber says, well, now it's a $1,000 call-out fee. Again, the building manager says, oh, ridiculously exorbitant, you're trying to rip me off. That's the price, you either take it or leave it. Well, I'm leaving it, and he hangs up. The third day, it's become unbearable. It's so bad that the building manager is willing to pay regardless. He rings up the plumber says, well, now it's a $2,000 call-out fee. Don't worry, get out here, fix the problem. The plumber walks out to the block of units. He walks around the block of units a couple of times, walks up to a pipe, bang, 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 with his hand on the pipe, and everything flows away. And he hands the building manager a $2,000 fee. The manager, flabbergasted, says to him, well, I could have done that. The plumber says, but did you know where to belt it? A lot of people think accountants, all they do is take their numbers and plug them into a tax return. But do you know where to plug them into? Do you know the questions that have to be answered ancillary to the information that goes into your tax return? I'm not trying to plug any particular accounting firm or accountants in general, but you have horses for courses. Accountants are there to help you through the maze of taxation. They will help you lodge. They should advise you on your evidence that you need, and they should be talking to you about your intention. Intention when it comes to taxation is everything. It can mean the difference between a 50% general exemption for capital gains tax and paying tax on the entire profit of an asset that was realised. Again, this is one of those things that probably is one of those unknown unknowns when it comes to dealing with property investment. That's why we at Property Portfolio Solutions put together the best of both worlds. We've got the property people on one side, that's Sean Davison, my co-founder. We've got me on the other side, the taxation expert who deals not only in taxation but structuring transactions to give the best outcome from what your why is with your journey to where you want to go. If you want to talk to us, all you've got to do, www.propertyportfoliosolutions.com.au, or drop us a line at info@propertyportfoliosolutions.com.au, and we can help you on that journey to where you want to go. At Property Portfolio Solutions, your